the ABCD pattern. It's a pretty important pattern in stock trading, options trading, any types of trading, and it can provide traders with greater insight into market movements and even give potential entry points. So the original pattern is based on Fibonacci ratios, and it uses 4 points, A, B, C, and D. So a trader will use this pattern to determine whether prices are likely to form a bullish or bearish reversal. Now, the key components that make up the standard pattern are point A, and this represents where the pattern begins, and that's when a trader should start looking for the ABCD formation. At point B, this indicates either a peak or a trough in price, depends on the direction of A. At C, this shows where the counter trend move has ended. And D, this is where the formation completes. So when all 4 points have been identified, traders can then look at how far apart each point is from one another using Fibonacci ratios. Now, these numbers represent how much retracement there will be between the 2 points before price reverses. So to have a valid ABCD pattern, and this is the classic one, all 4 points must line up correctly according to these ratios. Now, close is close enough. So it's a pretty powerful pattern for reversals and trend continuations. It's a really good pattern to know. But you can also use this pattern to identify potential support and resistance levels, and that area can be used for stop losses or even take profits. So, for example, if a trader identifies that prices reached a certain level, which here is point C, well, then they may decide to place a stop loss order below that level so that if price falls further and they're in that trade, their position can be closed. If price reaches another level, point D, well, then they may decide to take profits by closing their position. And you can use this pattern to also identify trends. So if there's a downtrend present, well, then traders may look for opportunities where price has retreated from point D, yet remain below point C. So that suggests that the move still has some downside potential. This is a price action trending structure of lower highs and lower lows. That's all it is. A bullish ABCD pattern is traded the opposite way. You'd be looking for any break below the C leg of the pattern. So by understanding how this pattern works and what it indicates about current market conditions, I think a trader can be better equipped to make better trading decisions. So how do you trade with it? So now you know that there's a classic way, right? Fibonacci ratios, measurements. You know what? Trading patterns in price, it's a good approach. It really is. But they don't have to fit such rigid rules, right? It's not the retracement that matters. It's not the fib ratio that matters. It's what price actually means. And the ABCD pattern, it doesn't have to be traded with those ratios. Now, that's the ideal one, of course. We can even simplify it. And we use this formula. A to B move equals C to D move. That's it. And that's how I use it. So on this price chart here, we're looking at market direction to the downside. Okay, so the pattern begins, we have a move down. We find some support level. So this would be our A leg, right? Our A to B leg of the move. Then we're going to look for a rally in price. And once price begins to break down, we're looking for that C to D leg with the profit target at the end of that move. But what we're looking for is equivalent price legs. And oftentimes that is exactly what we get. I didn't cherry pick this example. At the end of the move, we expect to see some type of reversal. We can take profits or even just be aggressive with our stop loss. Here's a simple strategy using moving average and ABCD. And it works best when there's no major news events that can affect price movements in either direction. So for example, if you're looking for the release of an earnings report, we'd probably want to wait until the smoke clears before looking to take a trade. So we want to identify trading opportunities. So we're going to look for price to be near a long-term moving average. It doesn't matter what you're using. This is a 50-day moving average. So we just look for a leg up in price. That identifies the peak of the current market direction. That's our A to B move. So this chart here, we see price above the moving average. We see a gap up in price shows that traders were aggressively buying in that area. So we can easily plot that A to B move. And now we need to get a pullback. So once in the trade here at C, you measure the move from A to B, project it from C. Some traders would just place a sell order at D to get out of that trade automatically. Other traders may decide to sell half their positions at the 50% point of that C to D move. Your stop loss can go under the low at C. When you use moving averages as part of your strategy with this pattern, Just choose one that fits your time frame and fits your risk tolerance level. If you prefer shorter term trades, if you're day trading, then maybe a 10-day or a 20-day may be fine. Longer term, 50-day or 200-day. We're just looking for trend. If you're a swing trader, you may want to explore everything from the 20-period SMA and upwards. And once you find the appropriate moving average and that pattern is visible, then you just decide how you're going to enter the trade. And that entry has to be in line with your risk tolerance, entry techniques, and even how you plan on taking profits. If you are an options trader, you may choose to purchase calls or puts, depending on the price direction, with a strike price around the end of the C leg. So here's some common questions. Is the pattern any good? Well, it's based on the idea that prices tend to move in repeating patterns over time. This stair-stepping pattern consists of higher highs and higher lows, or the opposite if you're going down. And that's what a trending market does. And this strategy has proven successful for traders. I'm a fan of it. It should be noted there's no guarantees. So it is a powerful pattern. I think all traders should understand it. You can identify reversal points, entry points, and even provide insight into the future price movements. But the key to success is understanding how it works. And this is in general with all patterns. How do they work? Why it works? Finding the obvious swing points to use. And when you combine this pattern with other technical indicators like the moving average like we did here, you can actually create a very effective trading strategy. It uses the rhythm of the market, which you can never go wrong with. And we talk about indicators, and if you're tired of using overused indicators, and I know a lot of people are, let's try something a little bit different. This is the ultimate guide to price pattern trading. It's totally free. You can find ideal entry points with lower risk, and it's probably one of our most popular free guides we've ever produced. You can download it. The link is to the left here, or it's down in the description. Thanks for watching.